Have you ever looked at a business and wondered, is it actually doing well or is it just getting by? Well, the answer isn't some big secret. It's written down, right there in its financial statements. Today, we're going to crack the code on those numbers and find out what's really going on inside any company. So, what is the real story behind all those numbers? I know it can seem super complicated, but I promise you it's way simpler than it looks. In fact, we're going to build the whole story from the ground up, right here, in about 5 minutes. You ready? Let's jump in.
You know, every financial story, doesn't matter how huge or complex the company is, it's all built from just 5 basic building blocks. If you can get your head around these 5 things, you've pretty much understood the whole game. So let's meet them.
First up, we've got assets. It's really simple. This is all the valuable stuff a company owns. We're talking physical things like their factories, their computers, the inventory sitting in a warehouse. But it's also stuff you can't touch, like cold hard cash in the bank. Basically, if the company owns it and it has value, it's an asset.
Next up are liabilities. This is pretty much the other side of the coin. It's all the stuff the company owes to other people. Think about a loan from a bank that has to be paid back, or maybe the bills they owe to their suppliers. It's their financial obligations.
And our third block is equity. Now, this one is absolutely crucial. Imagine you took all the company's assets and you used them to pay off all of its liabilities. Whatever's left over, that belongs to the owners. That's equity. It's the owner's real slice of the pie.
Okay, block number 4, income. You'll also hear this called revenue all the time. This is the money that's pouring into the business from what it actually does. You know, selling its products, providing its services. It's the big number at the very top. And finally, of course, there are expenses. As they say, you gotta spend money to make money. Expenses are all the costs of doing business. We're talking employee salaries, rent for the office, marketing costs, the cost of the actual stuff you sold. You get the picture.
Okay, we've got our 5 building blocks. So now, let's build our first story. This is called the profit and loss statement, or P&L for short, and its whole job is to answer one really important question. Over a certain amount of time, like a year, did we actually make or lose money?
The formula for figuring this out is like a super simple recipe. First, you start with all your revenue, all the money that came in. Then, you subtract the direct cost of sales. What's left is your gross profit, and that number tells you how much money you're making just from selling your core product. After that, you subtract all the other business expenses, and whatever's left at the bottom, that's your profit for the year.
Let's put some numbers to that. Say our company brought in $500,000 in revenue, and the cost of the goods it sold was $280,000. That leaves a gross profit of $220,000. Not bad. Then we subtract our other expenses, things like rent and salaries, which were $80,000. And voila, our profit for the year is $140,000. And just like that, story number 1 is complete.
So if our first story was like a movie showing what happened over the year, our second story is like a snapshot. A single photo taken at a specific moment in time. This is the balance sheet, and its job is to answer right now, today, what do we own and what do we owe?
And this snapshot follows one single, beautiful, and totally unbreakable rule. It's called the fundamental accounting equation, and it goes like this. Assets must always equal liabilities plus equity. This isn't just a friendly suggestion. It's like a law of financial physics. It has to balance.
Okay, but why does it have to balance? Well, think of it this way. The equation is just 2 different ways of looking at the very same pile of stuff. On one side, you have everything the company owns. That's all its assets. And on the other side, you have everybody who has a claim to those assets. And those claims can only come from 2 places, either outsiders the company owes money to, that's the liabilities, or the owners themselves, that's the equity. So it has to balance.
All right, so we've got these 2 big stories. We have the profit and loss statement, which is the movie of our performance, and we have the balance sheet, which is the snapshot of our finances. They seem kind of separate, right? Well, they're not. And this is the part where it all clicks. This is the aha moment.
Okay, step 1. Let's just remember the ending of our first story. Our company made a profit of $140,000 for the year. Got it? $140,000. Don't forget that number, it's about to become very important.
So what happens to that $140,000 in profit? It doesn't just disappear into thin air. It actually flows directly to the owners. It increases their stake in the company. It flows into equity.
More specifically, it gets added to a part of equity called retained earnings. So if we started the year with $50,000 in that account, we add our $140,000 profit, and now we have $190,000.
And this is the magic moment. We take that new retained earnings number, $190,000, and we plug it right into our balance sheet. And look at that. The assets on one side, $310,000, are now perfectly balanced by the liabilities plus our newly updated equity on the other side. The profit from story number 1 is the key that makes story number 2 work perfectly. That's the link.
So let's do a super quick recap. Financial statements aren't just boring numbers. They're a story in two parts: performance over time, which is the P&L, and financial position at one moment, the balance sheet. It's all built from those 5 simple elements. But the biggest takeaway? The two stories are connected. That profit a company makes, that's the bridge. It flows from the P&L right into equity on the balance sheet, proving that how a company performs directly changes what it's worth.
And just like that, you can now read the fundamental story that any business is telling with its numbers. So really, there's only one question left to ask. Now that you can read the story, what decisions would you make differently? Thanks for tuning in.